Cold open. A company can hold Bitcoin and still not be Bitcoin. That sounds obvious, but it is becoming one of the most important arguments in the market. Strategy proved that a public company can use capital markets to accumulate a huge Bitcoin position. 21 tried to turn the idea into a new kind of Bitcoin native company. Jack Mallers has been pushing the debate into the open. Is the business actually building something, or is the Bitcoin balance sheet the whole story? This is the Weekly Rebuttal. Steelman first. The strongest case for Bitcoin treasury companies is real. Most people cannot or will not self-custody. Institutions have mandates. Funds have wrappers. Retirement accounts have rails. Public market investors know how to buy shares long before they know how to hold keys. So a Bitcoin treasury company becomes a bridge. It gives traditional capital a familiar wrapper around an unfamiliar asset. It can raise equity. It can issue debt. It can hold cash reserves. It can talk to banks, auditors, exchanges, and investors in a language the old system understands. And if the company raises capital at a premium, buys more Bitcoin, and increases Bitcoin exposure per share, the bull case is simple. The wrapper can be accretive. That is the Saylor argument at its strongest. Not all dilution is automatically bad. If a company issues shares and receives something more valuable than what existing holders give up, the pie per share can improve. CoinDesk's June reporting captured that fight directly in the Saylor versus Mallers MNAV debate. The treasury model also creates a cultural effect. It makes Bitcoin legible on balance sheets. It forces analysts to talk about BTC per share, net asset value, capital structure, cash reserves, and convertibles. It makes Bitcoin harder to dismiss as internet money sitting outside the financial system. That is the steelman. Now the rebuttal. The balance sheet is not the business. Bitcoin on a corporate balance sheet is an asset. It is not automatically a product. It is not automatically cash flow. It is not automatically customer demand. And it is definitely not the same thing as owning Bitcoin in self-custody. When you buy a corporate wrapper, you do not hold the coins. You hold a claim on a company with a board, executives, legal obligations, possible preferred stock, possible convertible debt, cash reserves, issuance decisions, custody arrangements, and market sentiment around the premium or discount to its Bitcoin. That wrapper can be useful, but it is still a wrapper. This is why the recent 21 news matters. CoinDesk reported on July 21st that Tether controlled 21 named Raphael Zaguri CEO, replacing Jack Mallers, and that the earlier three-way merger plan with Strike and Electron had been abandoned. Mallers stepped aside to focus on Strike. The point is not drama. The point is structure. A Bitcoin company is still a company. Management changes, strategy changes, merger plans change, products may or may not ship, capital markets may open or close, a balance sheet can be clean while the operating story is unfinished. And that brings us to Mallers' more interesting point. In a filed presentation transcript, Mallers argued that many treasury companies are selling Bitcoin conviction while not focusing enough on operating business, products, cash flow, lending, credit, infrastructure, and growth. His ideal version is not just a company that stacks Bitcoin. It is a company that uses Bitcoin while building a real business around it. That is the line. Treasury strategy can be powerful, but treasury strategy is not a substitute for business quality. If a company trades at a premium to the value of its Bitcoin, that premium is a market opinion. It can expand, it can collapse. CoinDesk reported in late June that Strategy's enterprise MNAV had fallen below 1, meaning the enterprise value sat below the value of its Bitcoin holdings by that calculation. In that environment, issuing common shares can become dilutive instead of accretive. That is not a moral failure, it is math. The same machine that works beautifully when the market pays a premium can become much harder when the premium disappears. This is where Bitcoiners need to be precise. Bitcoin has no CEO. A treasury company has one. Bitcoin has no board. A treasury company has one. Bitcoin has no preferred stock. A treasury company might. Bitcoin does not issue more Bitcoin to buy dollars. A company can issue more shares, debt, or preferred securities to buy Bitcoin. Bitcoin does not need quarterly earnings calls. A company does. So when someone says the company is basically Bitcoin, that is where the argument breaks. No. It is a security wrapped around a strategy that uses Bitcoin. Sometimes that wrapper may be useful. Sometimes it may deserve a premium. Sometimes it may be a brilliant capital markets machine. but it is not the protocol. The honest investor question is not, do you like Sailor? It is not, do you like Mallers? It is not, do you like the orange logo? The honest question is, what exactly am I buying? Am I buying Bitcoin exposure? Am I buying an operating business? Am I buying financial engineering? Am I buying management execution? Am I buying a premium that must stay alive for the machine to keep working? Those are different things. The best treasury company bull case says, public capital markets can accumulate Bitcoin faster than many individuals can, and a smart capital structure can increase Bitcoin exposure per share over time. The best bear case says, the wrapper adds risks. Bitcoin itself does not have, and when the premium breaks, the shareholder may discover they own a complex capital stack, not clean Bitcoin. Both sides are right about something. The mistake is pretending the wrapper has no cost. This is not a call to hate treasury companies. Some of them may become serious Bitcoin businesses. Some may build useful products. Some may generate cash flow and use Bitcoin as their treasury asset. That is very different from treating the balance sheet itself as the business. The exit velocity view is simple. Bitcoin on the balance sheet is a receipt. It tells you the company understands the asset. It does not prove the company has customers, cash flow, durable products, or a capital structure that protects common holders in every market. So cheer the Bitcoin adoption. Read the filings. Respect the strategy. But do not confuse the wrapper with the thing inside it. Bitcoin is the asset with the fixed supply. The company is the instrument with management risk. That difference is not anti-Bitcoin. It is the whole point of thinking clearly in Bitcoin. Educational only, not financial, legal, tax, or investment advice. This is exit velocity. Think in Bitcoin.